Learning Objective 3 is to calculate and interpret revenue and spending variances. If we compare flexible budget and actual results, a revenue variance is the difference between what the total revenue should have been given the actual level of activity for the period and the actual total revenue. A spending variance is the difference between how much a cost should have been given the actual level of activity and the actual amount of a cost. We've compared the planning budget and the flexible budget and see the impact of change in activity on revenues, costs, and net operating income. But we haven't answered the question, has Larry done a good job or poor job controlling costs? And now we will take a look at revenue and spending variances to answer the question. This table reports Larry's flexible budget with actual results and calculates revenue and spending variances. Keep in mind, flexible budget is prepared based on actual level of activity and follows revenue and expenses formulas. Actual results report actual revenue and expenses. So comparing flexible budget with actual results is like comparing apples to apples because both budgets are prepared based on actual level of activity. In Larry's case here, 550 lawns mowed. Let's take a look at the revenue variance. Actual revenue is greater than the budgeted amount, which would be expected for 550 lawns mowed. So it's favorable. This could happen for a number of reasons, including increase in the amount charged for each lawn or change in lawn services. In Larry's case here, several homeowners requested some additional edging and trimming beyond the regular monthly service. So it results in increased revenue. Revenue variance is favorable. For spending variances, total actual expenses are greater than budgeted expenses for activity level of 550 lawns mowed. So spending variance for total expenses is unfavorable. Larry explained the individual spending variances. For wages and salaries, 2,000 unfavorable spending variance is because of extra hours required for the additional trimming. So Larry has paid more salaries to employees. 150 unfavorable gasoline and supplies spending variance is because of rising gasoline prices. Equipment maintenance spending variance is favorable. That's because Larry has delayed maintenance in order to get the extra edging and trimming work completed. Fixed cost variances are not the result of increased activity. Theoretically, they're constant, not sensitive to the change of level of activity. But here, office and shop utilities spending variance is favorable. That's because the weather is good in June, utility bill is less. For insurance, spending variance is unfavorable because insurance premium has increased. So actual insurance expense is more than expected for the same level of activity. And we can see here, overall, actual net operating income is $200 less than expected for activity level of 500 lawns mowed. Now we can prepare a performance report which combines activity variances and revenue and spending variances. Performance report is very important for managers to do performance evaluation. We will continue Larry's lawn service to combine activity and revenue and spending variances reports. This is Larry's Lawn Service Flexible Budget Performance Report, which shows both activity variances and revenue and spending variances. So you can see here, the activity variances are between planning budget and flexible budget. Revenue and spending variances are between flexible budget and actual results. So here, we combine what we've learned so far. Activity variances are the differences between the budget amounts in planning budget and flexible budget. The only difference is the level of activity. Of course, we can calculate the difference to get favorable or unfavorable revenue and expenses. But we also can use a shortcut to calculate activity variances. For example, to calculate the activity revenue variance, we can use the difference between actual level of activity and planned level of activity multiplied by $75. So here, 500 actual lawns mowed minus 500 planned lawns mowed, which is 50 lawns, multiplied by $70 per lawn. So we can get favorable activity revenue variance, 3,750. For wages and salaries, we can use 5,000 plus 50 lawns multiplied by $30 per lawn. And then we can calculate activity variance for wages and salaries is unfavorable, 1,500. And we can continue other activity variances in the same way. For revenue variance, that's the difference between flexible budget revenue and actual revenue. Actual revenue is higher than budgeted number, so it's favorable. For spending variances, there are the differences between flexible budget expenses and actual costs. And we can identify either favorable or unfavorable spending variances. Keep in mind, if actual costs are less than expected, spending variances are favorable. If actual costs are greater than expected expenses, they are unfavorable. This performance report is important for managers to evaluate performance and make decisions. From the table, we can see to generate a favorable activity variance for net operating income, managers should take actions to increase the level of activity. And also, to generate a favorable overall revenue and spending variances, managers should take actions to protect selling prices and increase operating efficiency. If revenues go up, costs go down, and of course, net operating income will go up.